Exercise 1110 is the first complete statement of cash flows you've been asked to do. So we're going to do the cash flows from operating, investing, and financing, which means we also have to consult both the income statement and the balance sheet to get some of our numbers. So we need income. We're going to get that from the income statement, and they tell us the net income for the year was $79,000. Now we know that cash could be more or less than that. Remember, cash varies directly with the change in liabilities, the change in equity, and inversely in the opposite direction of the change in non-cash assets. So as we examine the balance sheet, we'll go through and apply that. But for now, we're still on the income statement. And the next thing we're going to look at is depreciation expense. And as you remember, depreciation expense is a non-cash expense. So it reduces our taxable income. It does not decrease our cash, so we have to add that back. And we're told that our depreciation expense for the year was $150,000. So we'll have to add that back. $150,000. Now accounts receivable went down. So if accounts receivable goes down, accounts receivable is a non-cash asset. Accounts receivable goes down, cash has to go up $15,000. Inventory, again, inventory is a non-cash asset. So our inventory went up. So if our inventory went up, our cash had to come down. So that's $16,000. A decrease to our cash because our inventory went up. Prepaid rent is another one of those non-cash assets. So it went up. So our cash went down, and that was $3,000. And then we have our increase in accounts payable. Accounts payable is a liability. It goes in the same direction as cash. So our accounts payable went up, our cash went up, $15,000. We have interest payable, and a payable is a payable is a payable. A payable is a liability. So if our interest payable went down, our cash goes down by what, $6,900? And our income tax payable goes up, so our cash goes up. So let's take a look where our cash goes up, and it's the total of $4,000. Now let me make sure you're comfortable with where all of these numbers came from. Okay? Accounts receivable went down $15,000. Look at the comparative balance sheets for 2017, 2018. Accounts receivable went down, cash goes up. Inventory, again, look at the comparative balance sheets for 2017 and 2018. It was 89, it's now 105. Inventory went up 16,000. Cash comes down $16,000. Prepaid rent, again, looking at the balance sheet, we saw the prepaid rent last year was $3,000. This year, $6,000. Cash had to go down. Again, still looking at the comparative balance sheets. All of these come from the comparative balance sheets, and all of these can be analyzed using that model. Interest payable, $6,900. Take a look at our liabilities. You see interest payable was $13,800, is now $6,900. It went down. $6,900. The only thing that makes the bill go down is cash. And our income tax payable, we took the income tax expense. We didn't pay it yet. That payable went up, so our cash goes up. So that's where all of those numbers come from. After we get this number from the income statement and this number from the income statement, every other number comes from the balance sheet. Okay? So let's add those all together and see what we come up with. 79 plus 150 plus 15 minus 16 minus 3 plus 15 minus 69 plus 4. We end up with total cash from operating activities $237,100. But we're not done yet. We didn't have any gains or losses on the sale of land, so we don't have to remember to carry any of those forward. So we take a look at our cash from investing activities and our cash from financing activities, and then our summary change in cash. Well, they tell us in the additional information that we purchased equipment for $110,000. Well, if we purchased equipment, cash goes down $110,000. And you can see that on equipment. You can also see it in the information below. Then they tell us, again, this is in the additional information, the company repays $115,000 in notes payable. Well, if you pay, it means you're using cash. So that's a use of cash of $115,000. And we paid cash dividends, and again, this is in the additional information below. The company declares and pays a cash dividend of $30,000. So the cash used by financing activities is $145,000. Now we'll do our summary statement, our total. So let's take a look at our total increase in cash. Take our $237,100, $237,100 from operations, minus $110 from investing, minus $145 for financing, and when we put those all together, we're subtracting $155 from $237,100, and that's $17,900. So altogether, we used, our cash went down $17,900. We got $237 from operating. We used $110 in investing. We used $145 in financing. Our total change in cash is $17,900. Negative. Take a look at our cash at the beginning of the period. Look at the balance sheet. We find that our cash at the beginning of the period was $126,800. Our cash at the end of the period was $108,900, and that difference is indeed $17,900 negative.